Good morning, everybody. Welcome to our year-end planning webinar. We'll give everybody a couple minutes to get situated, and then I will do some introductions and some housekeeping items. Good morning, everyone. So glad to see everybody popping in. Hope everyone's having a great morning and had a nice Thanksgiving. Well, thank you for joining us this morning. I'm Betsy Reeves. I'm our marketing coordinator here at Elevate Wealth Advisory. We're so pleased you could join us today for our discussion about year-end planning, sort of a checklist of things to think about as you go toward the end of the year and start to think about 2022. Most of you already know, but our company formerly was Vickery Financial Services, and this summer we rebranded as Elevate Wealth Advisory. We really have appreciated everybody's positive feedback about the change. Before I introduce our speaker, just a few housekeeping items. For those of you who have not joined us for one of our monthly webinars yet, there is a chat box as well as a Q&A box down at the bottom of your screen. So if you have any questions throughout Rob's presentation today, just feel free to type those into either one of those areas. And then at the end of the webinar, I will pull up those questions and we'll start asking Rob to address some of them. If we don't have time to get through all of the questions today, you can email me directly at marketing@elevate-wealth.com, and I'll make sure that Rob gets your questions and we can get back to you personally. Also, this webinar is being recorded. So later today, I will send you a link to the recording once it's up on our YouTube channel. And that way you can share it with family or friends that you think might benefit. All of our past webinars we've done throughout the last year and a half are on that YouTube channel. If you'd like to look at that, you can find a link to that YouTube channel on our website. And our website is www.elevate-wealth.com. So now I'd like to introduce you to our speaker, Rob Physicist. He is a wealth advisor here at Elevate Wealth Advisory. Rob joined our team at Elevate in 2015, but his investment career actually began in 1992 as a securities analyst with the Principal Financial Group in Des Moines, Iowa. Rob continued on as a portfolio manager with Dimensional Fund Advisors in Santa Monica, California. After moving to Athens, Rob worked as an independent financial consultant before joining us here at Elevate. Rob is a graduate of the University of Iowa, and that's where he earned his Bachelor of Arts in Finance, and he minored in math. And then he earned his Master's of Business Administration from the University of Chicago Booth School of Business. Rob is a chartered financial analyst also. He and his wife, Sonia, who is a law professor here at UGA, live right here in Athens with their 2 children. And I will let Rob take it away.
All right, thanks very much. Thanks very much, Betsy, and good morning to everyone who's joining us live. Thank you for spending the next 45 minutes or so with me as we talk about year-end planning. I'm going to stop my video here and share my screen so you can see the presentation. Okay, hopefully everybody can see that PowerPoint slideshow now. And let me begin here with year-end planning. So I'll be talking about what it is, and hopefully by the end, we'll all agree why it is important and something that we should spend a little time thinking about. So the first thing I'm going to do is issue a disclaimer. Since I will be talking about taxes, I do need to say that I am not a CPA and that nothing in the presentation should be construed as professional tax advice. I will be showing some generic examples of planning strategies. Those strategies may or may not be applicable to your specific situation. Everyone's tax situation is different, so you should always consult a qualified tax advisor to discuss yours. All right, so with that out of the way, let's begin. So what is year-end planning? I'm going to start with a a big 20,000-foot view and a basic definition. When I talk about year-end planning, I basically mean these are action steps that we can all take before the end of the year, and they're designed to put ourselves in a better position for next year and beyond. And we often consider these items in the context of our finances. So when we think about year-end planning, certainly here at Elevate, we think about our investments, taxes, income, and expenses. But it does encompass some other areas of your life, such as healthcare and well-being. And a lot of these things we actually do naturally, or we think about them every year. So one example is giving to charity or making non-charitable gifts. This time of year, charities do their best business. November and December, people start to think about the charities they want to support and how much to give to each one, and how that might impact their taxes sometimes. If they give to a charity, it might possibly be a deductible donation. So that's something that we tend to do at the end of the year. We also might schedule our voluntary medical checkups, your vision and your dental checks. So there's a non-financial one, although sometimes we do that because we've used up our deductible for the year, or maybe we've even hit the out-of-pocket limit. So we try to scramble and get those done before the end of the year. We also consider using up the balances. If you have a flexible spending account, a childcare account, or healthcare account, you want to use those up. Sometimes those are use them or lose them. So that's a good year-end planning item to review. Occasionally, we might want to try to either accelerate or defer our income, kind of depending on whether we're having a low income year or a high income year, and how we might end up in a federal tax bracket. And if we have power over our income, we might seek to change that, to raise it or lower. We might consider taking some voluntary deductible expenses, if that might lower our income for the year, particularly related to real estate property ownership. You might be able to do that. It's a good time of the year to think about rebalancing an investment portfolio. You can do that throughout the year, but sometimes it just reminds us that we should get that done and maybe start the new year out with a portfolio that's back in line with their original targets. Another important item to look at is tax loss harvesting. And this would be looking through your taxable investments and seeing if maybe you've realized some gains this year, and possibly being able to offset some of those gains with losses before the end of the year, because that might save us a little bit in taxes when it comes due to file our returns. Since we pay capital gains tax on the net gains, you can offset losses against gains. So you want to review your portfolio for that potential planning opportunity. And we might want to look at our retirement accounts or health saving accounts or your college savings plan and see that have you made all the contributions that you want to make? What can you contribute? Is there room to contribute some more? And maybe get that done before the end of the year. And then another important one is if you are subject to a required minimum distribution, maybe you have if you're over age 72, or if you have an inherited IRA account, you might want to ensure that you've taken the required minimum distribution from that account, because there are penalties if you miss that. So you definitely want to check that out before December 31st. And then finally, if you have an IRA, you also might want to consider converting a portion of that IRA to a Roth account. And we'll talk a little bit more about that strategy later on in the webinar. Okay, so it's probably already becoming clear that there are a lot of items and areas in the year-end planning process to review. And so it's always good to have a checklist because it's easy to forget. There's just so many things to look at. And this is one of the best checklists that we found. And if you are interested, we're happy to send a copy of this out to you. Just let me or Betsy know. It all fits on one page, but there's a lot on here. And I won't be going through every single one of these today because in the interest of time, but I will be focusing on the tax area, the retirement area, investments, and milestones in particular. So don't worry if you didn't get a chance to look at everything on this page. There's a lot on here, but you can get a copy of this, and I'll be focusing in on quite a few of these before the end of the webinar. So before the end of the year, this is a great time to ask yourself, have I met any age milestones for the year? Because the rules for taxes and retirement accounts and contributions, things you can do, can change based on your age. And so it's a good time of the year to see if I've met any of these age milestones, because it might impact either what you can do or what you might need to do. So after age 50, you're allowed to make catch-up contributions to an IRA account. You can add another $1,000 per year to an IRA. And then some qualified retirement plans like 401ks, you may be able to contribute even more in a catch-up contribution after age 50. At age 55, you can take distributions from a 401k plan if you're retired without paying that 10% tax penalty. At 59 and a half, same thing for IRAs. You can now take distributions without penalty. It's still considered taxable income, but you can avoid the penalty once you've reached that age milestone. Between the ages of 62 and 70 is when people pretty universally will file for Social Security benefits. 62 is the earliest. Benefits are lower if you file early, and then your full retirement age generally between 65 and 67, and then benefits will increase if you wait until age 70, but beyond age 70 there's no benefit for waiting to file for Social Security benefits. So generally those benefits are taken between those 8 years. At 65, you can apply for Medicare. You're now eligible for Medicare. At 70 and a half, there's a gifting strategy that becomes available called the Qualified Charitable Distribution. And I'm going to go into quite a bit of detail about that later. But that doesn't happen, or it's not eligible for you until that age. And then at 72, this is where we become subject to mandatory required minimum distributions from IRAs and 401ks and all those tax deferred accounts that you've been saving money in for years and years and years, that now the IRS says it has to start coming out, and that begins at age 72. So that's another important age milestone. We'll definitely talk quite a bit about taxes. That's a major component of year-end planning. So this is also a great time of the year to review your income for this year and next year, and including your investment income. There may be some tax changes. Tax laws are always in flux. And there's actually some major pending tax legislation now in Congress, and we'll talk about that a little bit at the very end of this webinar. And of course, tax laws had a major change back in 2017 with the Tax Cuts and Jobs Act, and that impacts year-end planning as well. It's a good time to look at your realized or unrealized gains and losses in your investment portfolio and your taxable account, and see if there might be a way to minimize or reduce the tax impact of any gains that you've recognized. So you'll need your cost basis information on any securities that were sold, review your appreciated property sales, and maybe you have some carry loss forwards from prior years. You might be able to use those to offset gains this year. And good time to review your potential deductions, credits this year and next year, your charitable giving. We'll talk about that quite a bit too, and any other gifting plans, whether that's to charities or to non-charities. So sticking with our tax theme, it's important to know what the ultimate goal is when we are talking about tax planning in the context of year-end planning. Sometimes we're trying to keep our income below a certain bracket or avoid reaching the next higher bracket. So we're trying to limit our income We're trying to increase expenses, increase deductions, and trying to stay in a favorable tax bracket if you happen to find yourself in one. Occasionally it's the opposite. Maybe you're in a very low tax bracket and there's actually some room to recognize more income, increase your taxable income before moving into a higher bracket. So it's not always about minimizing income. Sometimes it actually makes sense to increase your income and possibly pay a little more in taxes now to avoid paying higher taxes in the future. So really, you should just keep in mind that the ultimate goal, the number one goal when we're talking about tax planning, is to minimize your lifetime taxes. So these are the total amount of taxes that you're going to pay over your entire life. We're trying to minimize that number, and that means it's sometimes counterintuitive, but that might mean that certain years you actually pay a little bit more in tax, and because you could save a lot in taxes in the future. So always keep that in mind for the ultimate tax planning goal. So back to other aspects of year-end planning. Many deadlines, but not all, do fall on December 31st. And so I'm going to organize this webinar basically in chronological order and talk about the deadlines that are going to come up first. Since it's already November 30th, we only have another month left in the year. I will be talking about those deadlines that do fall on December 31st. So these are the ones we need to focus on in the next 30 days. And a big one is charitable and non-charitable gifting. So let's focus actually on non-charitable gifting first. So these are gifts that you can make that are not made to an IRS recognized 501c3 organization. So they're not deductible gifts. So these are gifts you might make to family and friends and other individuals. There is an annual gift tax exclusion of $15,000 per person per year in 2021. So what that means is that you can give up to $15,000 to any individual, and more than one individual as an individual yourself, and not worry about paying any gift taxes or even filing a gift tax return. So as a married couple, for example, you could actually give $30,000 to each of your children, because that's $15,000 for each of you. So $30,000 per child, and again, not have to worry about gift taxes or filing a gift tax return. You could even stand on a street corner and just hand out $15,000 to every stranger that walks by, and give away a lot of money that way and never have to worry about gift taxes whatsoever. Remember, gifts are not considered taxable income to the recipient. And if you do end up giving more than $15,000 to an individual person within the same year, it's still very unlikely that you'd ever have to actually pay taxes on that gift. But what it does do is this, the amount over $15,000 effectively reduces your lifetime unified gift and estate tax exclusion, which is very high this year. It's $11.7 million per person. So if you were to give away more than $15,000 per person in 1 year, you would have to file a gift tax return just to keep track of that number. So that's a Form 709. And so I'll give a kind of an extreme example. If you were to give away $1 million to one person, you would need to file a gift tax return this year. And that gift tax return would then keep track of that large gift. And what would happen is your lifetime estate tax exclusion amount of 11.7 would now be reduced by that $1 million that you gave away. And so now your exclusion limit is $10.7 million. So this would normally not come into play for most people, but if you have a very large estate of over that amount, that's where it would end up affecting you. But basically, gift taxes are not something that most people worry about because this exclusion amount is so high. Okay, let's talk about other kinds of gift giving, and this is charitable giving now. So these are gifts to charities that are recognized by the IRS, again, 501c3 organizations. If you want your gift to count for this year, the receipt that you get back from the charity needs to be dated by December 31st, recognizing that they got your gift before the end of the year. Charitable gifts may be deductible. There are some limits, which we'll talk about. They're deductible really only, in most cases, only if you itemize your deductions. The deduction this year is limited to 30% of your adjusted gross income for non-cash gifts. So if you give property or appreciated securities, other kinds of non-cash gift, there's your income limited to 30% of your adjusted gross income for the year. You can give a cash gift up to 100% of your AGI. So you could, if you wanted to, actually give away enough cash to completely eliminate your income for the year, up to 100%. It used to be 60%, but they've raised that recently. And if you do give a very large gift where you hit any one of these limits, you actually can carry forward that deduction for 5 more years. So if you can't use it all this year, there's a good chance that you'll be able to use that in future years, up to 5 years going forward. There is a special provision in the tax law this year that allows for a deduction of $300 or for single filers, or $600 for married filing jointly, for a cash gift that goes directly to a charity, even if you do not itemize. So normally, those kind of gifts would not be deductible if you took the standard deduction, but there is this special provision, so you can deduct $300 or $600 depending on your filing status if it's a cash gift, and that cash gift must go directly to a 501c3 organization. So you cannot give that gift to a donor advised fund if you do happen to own one of those. Okay, so there are more than one way to give. There's more than one way to give a gift to a charity, and of course, the easiest and simplest is just cash. Charities love getting cash. It's the easiest and simplest for them, and they can use it to achieve their charitable goals in the easiest way. But a lot of charities are set up to take other kinds of gifts. They're happy to take liquid securities that can be sold pretty easily for cash. So that would include stocks and bonds and mutual funds, other kinds of investments that trade on an open market. They are often set up to be able to take those. And there's a benefit potentially to giving an appreciated security instead of just cash. And that is that you may be able to enjoy kind of a double tax benefit because when you give away an appreciated security, not only are you able to deduct the full amount of the fair market value of your donation, again, if you're itemizing deductions again, but you also avoid having to pay capital gains tax if you've got unrealized gains. So you kind of get a double tax benefit, and it might be an even better strategy from a tax point of view to donate appreciated securities rather than just cash. Now, the Tax Cuts and Jobs Act of 2017, one of the effects was it significantly raised the standard deduction or the standard exemption amount, because of that, it's kind of a higher hurdle now to be able to itemize deductions, because many more people claim that standard deduction because it's very high. I think for married couples, it's between 24 and 25,000 this year. So most people take the standard deductions, and fewer have enough other kinds of deductions that it makes sense to itemize. So this means kind of one of the negative consequences is if you give kind of moderate amounts to charity, often they're not deductible to you because you're just going to claim the standard deduction, and you really don't need to keep track of receipts and on your charitable giving, because you can give what you want, but it's not going to be deductible to you. So one strategy to sort of overcome this limitation is to consider bunching or bundling more than 1 year's worth of charitable gifts into a single year. So if you imagine what amount you typically give in a single year, if you can bundle that together and maybe give 2, 3, 4 years worth of donations in a single year, you might be able to exceed that standard deduction, at least for that year. And then you can get a tax benefit, because now you will be able to itemize your deductions because you've exceeded that large standard deduction amount. And so you give a big amount to charity in 1 year, and then maybe you don't give anything for year 2, year 3, year 4. And you may also be able to combine that strategy with a donor advised fund. And so this is sort of like a little mini private foundation where you get to you make an irrevocable gift to a fund, and you can typically name that fund how you want to name it. It's invested, but the way it works is you are able to fund that in a single year, and you can deduct typically the donation that you made to the donor advised fund, and then you have the option of issuing grants from that fund over any kind of time period that you want. So you don't have to actually give it all away in 1 year. You could issue grants over many, many years. And so when you combine that with the bunching strategy, you can give a large donation and put it in a donor advised fund, and then issue grants over several years. And so to the charities that you support, it's really not going to be much of a difference to them. They'll still get your gifts on the same schedule, but to you, you may be able to have a tax benefit by exceeding that standard deduction combined with the donor advised fund. Another gifting strategy is, mentioned this quickly before, is being able to use a qualified charitable distribution if you're eligible. And so let's actually focus on that over the next couple of minutes. So the qualified charitable distribution strategy, this is a strategy that opens up to you after age 70 and a half, where you can give up to $100,000 per person from an IRA. It has to come from a traditional IRA, not a 401k or 403b. And the donation must go directly to the charity. So the custodian will be involved, and they will issue a check to the charity instead of going to you. And the nice thing about this is if you're over age 72 also, this can count as your required minimum distribution, but it is not counted as income. So there can be a tax benefit to giving to charity in this method. You don't get a deduction because it's not a deductible charitable gift in that sense, but it's also not counted as income, whereas a standard required minimum distribution from an IRA would be counted as income. So let's illustrate a little bit how that might work. So imagine, let's take an example of like someone named Albert who owns an IRA, and Albert is over age 72, and so he needs to take RMDs from his IRA each year. And Albert decides to take his RMD at the beginning of the year, and his RMD is $5,000. And so he takes that, he's done with the RMD, he's satisfied that for the year. And then later in the year, being charitable, Albert decides to make a $5,000 gift to his favorite charity before the end of the year. The charity receives the $5,000, and But the RMD that Albert took at the beginning of the year is considered taxable income, and we'll just imagine that Albert's in the 24% tax bracket. So he will owe taxes of $1,200 on the RMD because it was income. And then so the total cost to him at the end of the year is $6,200 because that's the $5,000 that he gave to charity plus the tax owed on the RMD distribution of $1,200. So this is what a non-QCD contribution would cost. And again, to the charity, they still get $5,000, but the cost to Albert is $6,200. So let's contrast that with using the QCD strategy to see what the difference might be. So using the QCD strategy, the charity still receives $5,000, but the difference here is the IRA custodian will issue that $5,000 directly to the charity. So that's still a distribution. The $5,000 has come out of Albert's IRA. So his RMD is satisfied, but that $5,000 is excluded from taxable income. It's not considered taxable income at all. And so since this did not add any income to Albert's tax bill, he will not owe any tax on that distribution. Tax is zero. And so to him, the cost of this contribution strategy is $5,000. And it's a $1,200 savings from using this QCD option if you're eligible, rather than just kind of doing it the old-fashioned way, taking your RMD and then issuing a cash gift later in the year. So certainly something to consider if you're charitable and also subject to RMDs and are of the age that maybe a QCD works for you. So in addition to the QCD strategy and donating to charity, there's some other methods that we can use to perhaps control our income and affect the taxes that we pay. And one of those would be withdrawing tax-free money from a Roth account or perhaps a life insurance policy, money that we can live on, but that won't affect our taxable income. It might give us some options to keep our income low before the end of the year. Sometimes we can sell appreciated stock at little to no capital gains, depending on what tax bracket you're in. And I'm actually going to talk about that a little bit more in detail coming up soon. And if we are also in a low tax rate, maybe you can take advantage of that by maybe taking more from an IRA or a 401k to take full advantage of the low tax bracket that you might find yourself in. So all kinds of different ways to potentially manipulate your income to save taxes in the long run. Okay, so first of all, I promise this is the most complicated chart that I'm going to show today. And to be honest with you, this chart even confuses me a little bit. And I'm not going to go through every single step decision here. But what this chart is meant to illustrate is that sometimes a fairly simple seeming decision can actually be surprisingly complex. And so we'll walk through a couple of the steps here, but imagine, take as an example, if you're at the end of the year and let's say you own a taxable account with investments in that account that have taxable gains or unrealized gains. And you also own an IRA, a traditional IRA. So you've got a taxable account and an IRA. And you're trying to decide, should I consider doing a Roth conversion this year and maybe converting a portion of that traditional IRA to a Roth account, which we know is a taxable event and you'll pay taxes on that conversion. Or maybe you look to your taxable account and you say, I should consider maybe harvesting some of those gains in the securities I own and actually selling some of your appreciated assets and paying long-term capital gains, because long-term capital gains rates are generally pretty favorable. And so if you're trying to make that decision, what would be better for you? And so let's start on the left side of the chart. where your income is actually in the lower brackets. So we know that when you find yourself in a lower income year and you're in a lower tax bracket, these are generally good years to consider doing a Roth conversion, because we know that Roth conversions from an IRA account are taxable events. And if you're in a low bracket, you'll pay tax at a lower rate. And so it's definitely something to consider. However, when you're in one of the bottom two marginal federal tax brackets, the 10% or the 12%, your long-term capital gains rate is actually 0% when you find yourself in one of those low brackets. So in that case, you actually might be better off harvesting some of those long-term capital gains, at least until your income gets up to the third bracket, which is over $40,000 for single filers, and over $80,000 if you're married filing jointly. But below those income thresholds, you may be able to realize some of those gains in your taxable portfolio if you've held them for more than a year, and not pay any capital gains tax on that at all. And so since 0% is lower than 10 or 12%, that might be something to consider even before Roth conversions. Now, at the other end of the chart, if you look way off to the right, sort of in the opposite situation, maybe you're in a very high tax bracket this year. What if you are in one of the highest brackets, 32 or 35 or 37, and you have a lot of income in a particular year? That's actually another good time to consider doing long-term capital gains instead of a Roth conversion, because long-term capital gains are generally taxed more gently, either at the 15% rate or 20%, depending on your income. But that's a lot lower than 32 or 35 or 37. So it can be a wiser decision perhaps to look at long-term capital gains rather than do a Roth conversion in that year. And then kind of heading back to the center of the chart, actually going back to the first example where you're in a low bracket and you're looking at long-term capital gains, there's one caveat to that, which is if you find yourself in a position where you don't think you'll ever really need to sell assets in your taxable account because you've got enough other income coming in, and you actually intend to, instead of realize those gains, you intend to pass them on to your heirs because you don't think you'll ever need them. In that case, you probably don't want to realize any long-term capital gains, because your beneficiaries will be able to benefit from the step up in basis on inherited capital assets. So they won't have to pay capital gains taxes either on those assets. And so in that case, now you probably want to think more about Roth conversions because there's no need for you to recognize those capital gains yourself. And then and finally on this chart, if you are sort of in one of the middle tier tax brackets, like 22% or 24%, that actually can be a good time to look at Roth conversions, especially if it means by doing so, you are going to reduce the balance in your IRA account so that when required minimum distributions do ultimately come due after age 72, with lower balances in the IRA and higher balances in the Roth, you have increased the chance that those required minimum distributions won't bump you up into those higher tax brackets, the 32 or the 35 or the 37. So that can be a good long-term strategy to look at, doing a Roth conversion at one of these mid-tier tax brackets and avoiding a higher tax bracket in the future. And that's especially true if today's lower tax rates change and we end up with higher tax rates in the future. You'll want more of your balances in Roth accounts in that scenario. Okay, so as I've stated, low income years tend to be good years to consider Roth conversions, and that's because Roth conversions are taxable events. You have to pay tax on the amount that you convert. It's considered income. But nicely, Roth conversions are not an all or nothing proposition. You can do partial Roth conversions. And so you can actually look at your income for the year and sort of see how you might end up in the tax brackets structure for the year. And it's possible that maybe you're going to end up sort of halfway, sort of in the middle of a tax bracket, not close to a lower one or a higher one. And imagine if you find yourself in the 22% bracket, which is a pretty wide bracket. That one runs from about, for married couples, from about 80,000 up to about 170,000. So it's a pretty wide bracket. And if your income is sort of in the middle of that bracket, you might want to consider doing a Roth conversion up until the point where you would end up in the next higher bracket, the 24%. So if your income is, say, your taxable income is maybe going to be 120,000 this year, you could do a Roth conversion of $50,000 and raise your taxable income up to 170. But you'll still be in that 22% bracket because that's a big wide bracket, and the 24% doesn't start until over 170,000. So in this sense, you've taken full advantage of that relatively modest tax bracket of 22%, and you've filled it up, which is shown there on the bottom of this chart. After the Roth conversion, now you've taken your income up to the very top of that 22% bracket, but you have not reached the 24%. And now your IRA balances are lower, and hopefully in future years, when RMDs come due, you can remain in lower tax brackets when you have a little less control over your income. So that's called the filling up the bucket or filling up the bracket Roth conversion strategy. So a couple of potential tax traps to be aware of whenever you are looking at increasing your income, either through a Roth conversion or recognizing some capital gains. Be sure to consider a couple of these tax traps because it's not always just about marginal tax rates. There are other things to take into account. And one is, if you are on Medicare, remember that the premiums that you pay for Medicare are based on your modified adjusted gross income. So the more income that you recognize, it's possible that you will end up paying higher Medicare monthly premiums. There's a 2-year look back feature. So the brackets shown here are the 2022 Medicare premium brackets. So this is based on income that was reported in 2020. And so in 2022, based on that income, for individuals, if you earn less than 91,000 and joint couples filing jointly under 182, you can enjoy the lowest Medicare monthly premiums. But you can see how at higher income levels, the premiums start jumping up. And so again, when looking at altering your income and deciding to recognize more income, be sure and look at your Medicare brackets because that's something that could be affected too, and you don't want to end up kind of forgetting about that and paying a lot more in Medicare premiums. Another potential tax trap is the net investment income tax. This is also based on your modified adjusted gross income. And so at certain higher levels of adjusted gross income, you can be subject to a surtax of 3.8% on whatever your otherwise normal investment taxes would be on capital gains or interest tax or real estate tax. There's a surtax for higher income earners. And so again, if you're going to recognize some more income in this year, be sure to be aware of that potential tax trap so you don't end up paying more on your investment income and become subject to that surtax, or at least be aware of that. And it's just at higher income levels, over 250 for married couples, but certainly something to be aware of when we're talking about these income tax strategies. Okay, one more year-end planning deadline that does fall on 12/31 is tax loss harvesting. So if we have realized capital gains in our investment portfolio and our taxable accounts, you might be able to offset some or all of those gains by realizing capital losses. That needs to be done before the end of the year to count for the tax return you'll file in the spring. Remember, capital gains tax is owed on the net. So the difference between gains and losses. You can have a lot of gains, but not pay tax if you can offset those gains with losses. So it's a good idea to review your portfolio. Now, of course, in a year like this, there's not as many losses. 2021 has been a very good year in the markets. So losses might be a little harder to come by. So this strategy makes more sense in some years where we might have a downturn in the market and there's more losses on the books, but still something to look at because we might be able to save taxes by offsetting losses against our gains. And if you actually do have more losses than gains in your capital asset portfolio, you can also offset a small amount of your ordinary income through capital losses up to $3,000, and that's whether you're married filing jointly or for singles. And then if you have losses even beyond that, they can be carried forward indefinitely. So a year with big losses can kind of pay dividends for you and for many years to come if you're not able to recognize that all in a single year. Remember, the deadline is 12/31 to realize these losses if you have any in your portfolio. So not all planning items have a December 31st deadline. So I'm going to talk now about the ones that we actually have a little more time to consider and think about. And one of those is contributing to a non-employer sponsored tax deferred account. So that would be like a traditional IRA or a Roth account or a SEP IRA. The deadline is later for those kinds of accounts. There is an earned income requirement, so you do need to earn income through a salary or wages to be able to make a contribution to an IRA account, you or your spouse, or Roth or a SEP IRA. The limits this year for IRA and Roth accounts is $6,000 that you can contribute if you own one of those kinds of accounts, plus another $1,000 if you're over age 50. That's your catch-up contribution. The deadline for contributing to an IRA or a Roth is the tax filing date, which is April 15th of next year, 2022. So you can make a contribution all the way out to that date and still have it count for 2021. For a SEP IRA, it's your personal filing tax date. So it's possible to have that deadline extended even further out to October. If you get the extension that long, you could contribute to a SEP as late as October 15th of next year. And a relatively new provision as of January 1st, 2020, if you are over age 70 and a half, you can still make contributions to an IRA account as long as you've met that earned income requirement. Now, a common question that we get here at Elevate is, if I do decide to make a contribution to my traditional IRA, will that contribution be deductible to me? And that depends on a couple of things. So there is an income limitation, and there's also a limitation based on whether or not you or your spouse are covered by an employer-sponsored retirement plan. So here are some of the limits here to be aware of if you do want to try to deduct an IRA contribution. If you're single and you're already covered by an employer-sponsored plan, your ability to make a deductible contribution to a traditional IRA is phased out at an AGI of 66,000 to 76,000. If you're married and you're going to file jointly and you are covered by an employer plan, your phase out is a little higher. The range goes to 105 to 125 this year, so you could still deduct a contribution to a traditional IRA if you are under those income limits. If you're not covered by an employer, but you're married to someone who is, then your AGI phase out range is higher still, and that goes to 198,000 to 208. So in between those two numbers, your ability to deduct that contribution will get phased out to zero above 208. And those income limits are the same ones that apply to your ability to make a direct Roth contribution if you're married filing jointly. So that 198 to 208. So these are the things that we need to consider, whether when we're trying to determine if you can save a little bit on taxes by making an IRA contribution. So you need to be aware of those specifications, your employer plan, and your income for the year. So I'll wrap up here in the next couple of minutes talking about some pending legislation that's in Congress right now. This is the second part of the Build Back Better legislation. Remember, a few weeks ago, the infrastructure bill passed, and President Biden signed that into law. But there's still a larger part of the bill, which has just passed the House and is now sitting in the Senate. It may or may not pass by the end of the year. They're going to try hard. It's not a certainty yet. But if it does pass, it looks like there's some provisions that could affect some people who are planning here on this call. And one of the bigger ones is the potential elimination of the backdoor Roth conversion. So this is a strategy that's been in place for a few years where even people who make more than the limit for being able to make a direct Roth contribution, if they're over that, for example, over 208,000 in modified adjusted gross income, if they're married, there's still a way to get around that income limitation by making a non-deductible contribution to a traditional IRA and then converting that balance to a Roth account. But it looks like if this legislation passes, this is going to be the last year that strategy is available. They are looking very hard at eliminating that backdoor Roth conversion strategy. So that might begin in 2022. There may be a ban on all Roth conversions for the highest income earners in 10 years. So if you are a very high earner making over $400,000 a year as a single or $450,000 as a couple, you may lose the ability to convert any of your IRA balances to Roth, but again, not for 10 years, starting in 2032. And if you have a high income and a very, very high retirement balance in an IRA, they're also talking about forcing required minimum distributions of 50% of the amount over $10 million. So if you have an IRA balance over 10 million, you might be facing some big RMDs for a few years until those balances get under 10 million. And then if you're over $20 million, you may be forced to take 100% RMD down to the 20 million, starting with Roth accounts first. So again, those aren't going to impact too many people. Not very many people have balances that high in their IRA accounts, but looks like that's going to be part of this law if it passes. And I'll leave you with some good news, potentially. Again, if this bill passes, there may be some good news in it for property owners, especially property owners in high tax states. And if you have a mortgage and pay a lot in property taxes. If you recall, the Tax Cuts and Jobs Act of 2017 introduced a hard cap of $10,000 on the amount that you can deduct for state and local property taxes on your tax bill. But the pending legislation that may pass by the end of the year they're talking about raising that cap substantially as high as $80,000 for 10 years, beginning this year. So if it passes, you wouldn't have a lot of time to plan for that because it looks like this bill may kind of go down to the wire. But if it does pass in its current form, you may get some SALT cap relief if you have a property and and have state and local taxes over that $10,000 limit, you might actually get a tax cut this year if this bill passes. And of course, if it does pass, it means more people will itemize their deductions rather than just take the standard. And so that might mean their charitable donations are more likely to be deductible for them as well. So we'll see. We'll keep an eye on that, see if that passes and the impact that may have. So with that concludes my prepared remarks. I'll wrap it up here and toss it back to Betsy and see if there's any questions for me.
Thank you so much, Rob. That was so informative, and I definitely will be sending that checklist out to everybody via email. And then also some of the other flow charts that you mentioned, I think that some people would like copies of those as well. So I will go ahead and get those from you and send those out to everybody. One question we have is, what month is the best time to begin looking at this year-end checklist, just to make sure you're not scrambling at the end of the year to meet all these items?
Yeah, and that's a tough one because on one hand you say the earlier the better, but a lot of this depends on what your income is going to be for the year, and you often don't know that until the end of the year. So it's some of these things can't be done until maybe the last 3 months of the year, when you have a really much better sense of what your income is going to be. So I would just say as soon as you do have a good handle on your income and your charitable plans, then that's probably a good time to take a look at that. So sooner is always better, but you do have to wait for that data to come in before you can really make these plans. Okay,
very good. And then another question is, you had mentioned in the beginning that you're not a tax advisor. So when is the best time to meet with your CPA or your tax advisor to make sure that you are also checking off these boxes?
Well, I think tax advisors and CPAs generally want you to have your W-2s back. And so they want to be able to know your income and your deductions and all the contributions that you've made to your employer-sponsored plan. And so generally, these forms that they're going to need to see become available around the very end of January or very early February. That's also when you're going to start getting the reports about distributions on your investments. If you have mutual funds and they've made some distributions, capital gains or income distributions over the year, those generally start to become available maybe mid-February. And so if you want to make an appointment maybe toward the end of February or early March, you should have all the information you need and hopefully still several weeks to make any other changes or plans and have plenty of time to get the taxes done.
Very good. Well, those are our questions. And if you end up thinking of a question later that maybe pops in your head, feel free to email them to me and I will make sure that Rob gets them. You can send them to marketing@elevate-wealth.com. Also, I will send out a recording to the webinar later today to everybody so that you can refer back to it or share it with any family or friends. I'll also send out the checklist as well as the flow charts that Rob mentioned. And then if you want to look at our list of upcoming webinars, we do have one in December. It is about philanthropy and charitable giving, which Rob did cover a little bit today. So that will be at the end of December. You can see all of our upcoming webinars on our website at elevate-wealth.com. And that's where you'll also find the link to our YouTube channel to view our past webinars. We've got our 2022 webinars scheduled. They're not up on the website yet, but they will be by the end of the week. So you'll be able to see what we've got going on in 2022. And again, we just thank you all for joining us today. And thank you, Rob, for your time putting this together. It's been very informative and we really thank you.
Great. Thank you very much.
All right. Bye, everybody. Have a great day.